Hello everyone. In this video, I'm going to talk about the three important indicators which are widely used by traders to identify the potential reversal in the markets, the divergence, and to identify the trend and momentum of the market. So let's begin with the chart. Here I'm using the chart of gold, that is XAU-USD, and the time frame is 2 hours. Here you can see the price action of the gold. I have applied three indicators. First one is the relative strength index, second one is MACD, that is moving average convergence divergence, third one is the money flow index. Now let's begin with relative strength index. This is called momentum oscillator, and this particular indicator is used to identify the trend of the market and also to identify the momentum. You can see the two lines here. The first one is yellow color line. This is RSI based moving average, and the second one we have blue color line. This is RSI, that is relative strength index. And here we have three levels, that is one is 30 and center one is 50, and the third one on the top we can see this dotted lines, this is 70. So if the market or if the relative strength index moves above this particular level, that is 70 level, it is understood that market or the asset is overbought. From this particular moment, there could be a consolidation or a strong reversal. Similarly, if the relative strength index moves below this 30 level, it is understood that the market is oversold. From this particular point, there could be a potential reversal or rebound. Next, we come for this MACD. Here we can see on the center, we can see the volume distribution, and we have here two lines, that is red color line, we call this one as the signal line, and blue color line is MACD line. And whenever there is a MACD line crosses the signal line, we call this one as the bearish crossover, that is from the top. Similarly, whenever the MACD line crosses the signal line from the bottom, we call this one as the bullish crossover. And third one, we have money flow index. Now, what is the difference between RSI and money flow index? RSI is calculated based on only the price, but here money flow index is calculated by using both the price as well as volume. That's why when we combine this RSI indicator along with money flow index, it always results better. Here also we can see the three levels. One is 20, 50 and 80. Whenever the money flow index moves above this level, that is 80 level, it is understood that the market is overbought area and there could be a sharp reversal from this particular point. Similarly, whenever the money flow index moves below this 20 level, it is the oversold area. From this particular point, there could be a recovery or rebound of the market. Now, by using all this combination of these three indicators, how we can enter into the position? Let us see one example. Now here I am showing the short position. Okay, so now let us consider this particular moment. Here you can see the price is rising, the bullish momentum, and when we see this RSI indicator, we can see that that RSI has crossed this 70 level, which indicates it's a overbought position or the asset is overvalued. And here what I did is I have drawn one line here joining the two extreme points of the candlesticks for this particular moment, and for the same corresponding points I have drawn the line for the RSI. Now we can see here the price is rising, but the RSI indicator, it is declining. So this is called divergence. Similarly, what I did is for the same corresponding points, I have drawn the line for the MACD also, which is also declining, and also this particular point we can see here the bearish crossover, that is MACD line is crossing the signal line. So this indicates that we can the entry point of the short position. Money flow index, here also I have drawn the line for the same corresponding points. This is also declining. So combining all these three, RSI is declining, MACD is declining, and also this money flow index, this is also declining, but only the price is rising. So this indicates or tells us there is a divergence in the market. So there is a high probability that market would reverse from this particular point. But before entering into the positions, we should always wait for the strong reversal pattern. Here we can see we have the inverted hammer here. So we can enter the position here with the risk to reward management of 1:3, and we can exit the positions at the next support level. One more example which I want to show you for the long position, and here you can see that the trend of the market, this is a bearish momentum, okay, bearish trend. Here I have drawn the line. You can see here the price is declining, and for the same corresponding points, I have drawn the line for the RSI. You can see this is rising. So this is called divergence. You can see the price is declining and RSI is rising. So this is divergence. And similarly, I have drawn for the same corresponding points, I have drawn the line for this MACD. MACD is also rising. And on the MACD, you can see here the crossover, that is the bullish crossover at this particular point. Before entering the trade, we have to wait for the proper reversal patterns. Here you can see the reversal patterns, that is we have the hammer as well as green bar clearing the red bar. So we can enter at this particular point and we can keep the stop loss below this tail with the risk to reward ratio of 1:3, which is very, very good. And if you feel that this video is helpful for you, kindly do share among with your friends. Do like and subscribe to this channel. Thank you. Thank you so much for watching.